Have you ever heard of a bird in the hand is better than two in the bush? This is an age-old saying, and it speaks to really some of the fascinating things about investing. One being, of course, risk, right? Because the sure thing that you've got in your hand is better than the risky thing that is uncertain in the future. The other thing that is interesting when I say this bird in the hand thing is the time value of money, and that's another fundamental concept of investing. And the time value of money basically is the very simple concept that money in your hands today is better than money coming to you tomorrow, in a year, or in 10 years. We all know this intuitively, but in finance, it really becomes mathematical and to some extent an art as well. And so just to play out the example, if I told you, hey, I'll pay you $100 today, you're very happy. But if I tell you, yeah, I'll pay you $100 10 years from now, you're not going to be as happy. And in finance, you use a discount rate to be able to figure out what the net present value is of a future cash flow. So without getting into all the nerdy stuff, that's basically the simple concept of the time value of money. Money sooner is better than money later. So when talking about making investments into private syndications in real estate, something very important is, of course, the time value of money. And the way that you see that taken into account is through a preferred return in a waterfall structure. We're not going to cover the whole concept of what a preferred return and what a waterfall is today, but we're going to zero in on the concept of compounding, because compounding is basically the process where interest earns interest upon itself. And that's where you go 1 + 1, but then it goes from 1 + 1, 2 + 2, and you've built up a compounding return. And that's how people talk about, hey, if you save for 30 years, you get rich in the end because you saved $10,000 and it turned into $1 million. And how did it do that? It's through the power of compounding. And you really have to utilize the power of compounding wealth over time to really get ahead. So through the preferred return mechanism in private real estate partnerships, the proper way for those to be structured is actually such that they are a compounding preferred return. And many of our peers or other syndicators like ourselves actually don't offer a compounding preferred return. It's just a simple accrual. For example, a sponsor might offer a 7% simple preferred return, where they basically owe you a 7% return per year. And if they don't hit that, let's say they only hit 5%, the remaining 2 just gets accrued and tacked on to your balance for the next year, which is great, at least such that you'll hopefully get caught up at some point, but it's not quite as good because you're not being compensated for your time value of money, because obviously you'd rather get that 7% today and not have to wait for it. And that's being solved through the mechanism of compounding, where when the preferred return is compounding, let's say it's a 7% compounding pref, if you only get paid 5% in a given year, the 2% gap doesn't just accrue and get tacked on to the next period, it actually gets tacked on to the capital account basis, and you actually are now owed 7% on your original balance plus the 2%. So it sounds kind of complicated and abstract. So to make it a little more understandable, let's imagine a $100,000 investment. If you receive a 5% cash on cash in a given year for that $100,000 investment, you received $5,000, and you're still owed the remaining $2,000. So that $2,000, like I said, would accrue and be tacked on to your capital account. So effectively, per the compounding calculation, per the waterfall, you would actually now have technically invested $102,000, and you'd be accruing 7% cash on cash, or 7% preferred return on $102,000. So it wouldn't just be $7,000 in preferred return that you're owed, it'd be $7,000 plus a little bit of change. And that is how the compounding mechanism of a properly structured preferred return works. So at LSCRE, we of course put our investors first, so we have a compounding preferred return that compensates investors for the time value of money.